Good day. Welcome to Colliers' first installment of an information series, which is hosted by our evaluation and appraisal teams. Uh, for the next couple of months, each 2 weeks, we're going to cover some new topics and specific asset classes on commercial real estate, primarily around valuation and appraisal considerations. My name is David Bowden. I'm the Vice Chair of our Strategy and Consulting Group, and I'll be moderating today's panel. Let me start by introducing our four speakers today. Scott Chandler, who's a Senior Vice President of our Investment Services Group, and Scott is based in Toronto. Vincente Gamboa, a Senior Member of our Valuation team, and he's also based in Toronto. We have Mark Berestansky, who is the Managing Director of our Valuation team in Calgary. And we have James Glenn, a Senior Member of our Valuation Group in Vancouver. So I can appreciate, as I'm sure you can, that we're living in a very fluid situation today. The plan in today's session is to talk about and address some of the key issues and insights into our industry, and more specifically, considerations that need to be given to the valuation and appraisal process. Before turning it to Scott, who will be our first speaker, I thought you might be interested in some general stats and some of our other business lines in terms of real-time information. So the two areas that I wanted to touch on, the first is in terms of transaction volume, and then the second is in terms of deferments and rents from our property management tenant base. So again, for context, as it relates to transaction volumes, on an annual basis, Colliers Canada completes about 6,000 projects a year. 1,300 of those are property sales. The remainder are leases. I would caution you to not to put too much stock in what I'm about to say, because the timelines are relatively short. But in today, as people are thirsty for different types of information, I thought you might find this interesting. If we compare our transaction volume for the last 12 business days of March against the last 12 business days of February, the transaction volume in our brokerage group was almost the same, down about 5% in March from February. So maybe a little bit surprising, and certainly encouraging. Contrast that to the first 7 working days of April against the first 7 working days of March. Transaction volumes did fall off. They fall off a little less than 40%. So volumes were down. You could look at that as a glass half full or a glass half empty perspective. If we look at it from a glass half full standpoint, I think what we will have in the coming weeks is a much better sense of how, if at all, property values are changing, and how, if at all, lease rates are changing. So we're actually encouraged that the volumes are as high as they are, and assuming that continues, I think we'll have some great insights. From a management perspective, we manage approximately 65 million square feet of office, retail, and industrial space. The largest of the 3 components is office, but we have substantial management responsibilities in both retail and in industrial. A question that a lot of people are asking is, how stable is the rent roll? What types of tenants are looking for abatements or deferrals? So I would share this with you. I'll go from worst to best. Worst, not surprisingly, is in the retail segment. Approximately 60% of our retail tenant base was looking for either a deferral or an abatement. What was interesting, and that's not surprising, but what was interesting is the vast majority of them were in deferrals, so that the tenants fully expected to make up the difference. But there were a couple of abatements, but not that many. The next was in the office environment, where just under 25% of the tenants in our portfolio, our total portfolio, by the way, consists of 9,000 tenants, so I think it's statistically relevant. 25% of our tenant base in the office arena were looking for some form of deferral. And then the best performing asset class was industrial, where only 5% of the tenant base was looking for some type of deferral. I would expect that those numbers for May's rent and June's rent are likely to be the same, if not possibly a little bit worse. But we thought we would share that information with you because information is sometimes difficult to come by in today's environment. So with that said, I'm going to turn it to our first panelist, Scott Chandler. Scott, maybe you can share what you're seeing in the market, and hopefully you can share some of the results of our investor sentiment survey that I believe you and your team has recently completed. So over to you.
Great. Thanks, David. I hope everyone can hear me. Certainly, as you said, fluid times. I'm going to go through a bit of what we've been seeing. I think we can learn a bit from history. Every recession seems to be a little different, but I think we can maybe glean some information from the past. Like you said, I'll go through what we're experiencing right now and maybe give some forward-looking thoughts of where I see it going. My role is in the national brokerage team at Colliers. We work across Canada. My business right now is on pause. It's very hard to market opportunities right now. We do have some outstanding mandates, but clearly the whole market very quickly went into pause mode. So I'll touch upon that a bit too. Maybe just spend a bit of time to remind everyone where we were coming from. And looking back at February, seems like a very, very long time ago now, but in February 2020, we were coming off a third year of about $35 billion of sales volume across Canada in the industrial, office, retail, and apartment sectors. A very strong continuation of what has been three very, very good years. Historically low vacancy rates and North America-wide low vacancy rates in the downtown office and industrial markets in many of our Canadian metro areas. But you might remember not all cylinders were firing. Obviously, Alberta and Saskatchewan have been hurting since 2014, 2015. And you remember how much the market was focusing on Montreal, Toronto, and Vancouver. Those MTV markets were really attracting the vast majority of investor interest. I'm sure Mark will talk a bit more about Alberta, but just remind everyone the asset types were diverging a bit. And I think that's a polarization that will become even more exacerbated as we go through this pandemic. The IPD returns across Canada for office, for industrial and apartment, I should say, they were 10 to 15% in 2019. Huge numbers. Office was chugging along mostly downtown, but averaged 7 to 8% returns in 2019. And retail already was really starting to show cracks. It was 2%, less than 2% overall returns, with enclosed malls negative returns in 2019. So certainly it was not a broad-based good investment market, and I think this current situation is only going to polarize even more what we started to see. I also remind everyone on the public real estate side, the REITs had their largest equity and debt issuance years ever in 2019. It was a huge year for the public real estate sector. And, they were up roughly 25% on average in 2019. So again, a lot of financial strength coming into 2019. A lot of discussions we were having with our national investment clients about how long it could last. And a lot of specialization was starting to happen already. Funds were increasingly focused on core markets, on development, getting a little wary about retail, and very focused on industrial and apartments. So just to remind everyone, it wasn't a broad-based expansion even in February 2020, but obviously things are a lot different now. I think times like this, it's interesting to look back. When we've been through these recessions, it's been a long, long time since we've had a severe recession. And I'm old enough to remember the late 1990s. early 1990s recession and how profound that was. And people are generally going to draw comparisons between that recession and the financial crisis of 2008, 2009. And just to remind people, if you're around or educate people who weren't, in the early 1990s, 89 to 93, there was hyperinflation, there was overbuilding, there was cowboy entrepreneurial developers, and there was questionable lending practices. This was a long time building, and there was hyperinflation. Office vacancy rates in downtown Toronto went from 7% to 19% for Class A. Net effective rents were mid-20s to zero. What's really profound is how long that lasted. It really changed the industry for a long time. And if you're around then, you'll remember. But it was centered around real estate, that recession. And what's profound is the banks stopped lending. And they really didn't get back to lending levels for a decade. And very strong global Canadian names fell by the wayside, ONY, Campo, and Bramalea, for example. So a very deep, profound commercial real estate recession. I don't think we're going to see that this go around. In contrast, the global financial crisis in 2008, 2009, it was a huge, quick, profound shock to financial markets and certainly in the lending community as well. But it was relatively short-lived. The banks and certainly well-heeled investors skated right through that recession. And as Dave reminded me, a lot of people regret not taking advantage of the opportunities quicker during that downturn. IPD returns were negative for only 3 quarters in 2009, and they were positive and double-digit by the end of 2010. So that was a very short-lived recession and downturn in commercial real estate. What's interesting to compare and contrast those is one was a real economic recession, and in the 2008, 2009, there was an economic recession, but it was really financially driven. And it feels like we're in between, to be honest. There is real economic pause and decline happening today. A total stop in the economy is a hard thing to ignore, and what that means for the ability to pay rents, the ability to invest, the ability to even transact. It feels like this is much more profound than the 2008, 2009 financial crisis, from that regard. What's different from the early 90s recession, though, is low interest rates and disciplined investors, and basically from a stronger position and low inflation. So I think we'll see an outcome that's somewhere between there, but I think we've got some lessons to learn from both of those downturns. So what are we seeing now? Really not a lot's trading. The public markets are probably the best indicator right now because they trade every day. And it hasn't been as bad as many people thought, certainly compared to other stock market downturns. On average, the Canadian REITs are off about 30% from peaks, which was February 20th. But it's not evenly distributed. No surprise, but industrial and apartments are off only 20 to 25%. Retail is only off 27% because in Canada, the public REITs are very grocery anchored. So they've certainly in a different position. Office is off 28, 30%, but diversified REITs are off 50%. And those are the ones that hold the retail, the enclosed malls, and they're really getting hurt more than average compared to the rest of the public market. So interesting to see a very large investment community, what their call is on the public real estate right now. And of course, this is being aided by tremendous liquidity and support from governments and financial institutions. David mentioned the COVID survey that Colliers has undertaken. It was taken place about a week and a half ago, and we surveyed our investor clients, a mix of public, institutional, and public investor clients. And it's early days, and we're going to continue to do this survey every 2 weeks. The next one comes out later this week. The survey does, and the results will be next week. But it had some indication of what the investment community is thinking. We asked what they think, how long it'll take before the economy gets close to normal, and it was evenly split. 40% said 6 months, 44% said 12 months. I think 6 to 12 months is a standard response when you enter a recession, and we'll see where that goes over time. About half of the respondents said pricing will decline 10 to 20% in Q2. That's a very much a postulation right now, but I think speaking to our investor clients, we're seeing the same sort of magnitude being discussed right now. We'll see where that goes over time. Clearly, the primary concerns right now are tenant solvency. How will rent and NOI and cash flow continue over the short term? And then what's relevant is the next most common response was, what's going to happen to pricing? The investor community is really trying to put what's the end game on pricing, not just 6 months from now, but a year and a half, 2 years, 5 years from now. And then, of course, what's the long-term real economic impacts? Tying in very much to the Colliers results that David mentioned, I pulled the transaction volumes in across Canada, and for Q1, it was actually up. It was slightly up, not unlike what our experience was at brokerage volumes at Colliers. Since March, the beginning of March, transaction volumes are off 47%. So again, not dissimilar to the small sample that David mentioned. Real Capital Analytics announced their Q1 volume results for Asia, and they were off 45% for Q1. And Asia was very much ahead of us in terms of the COVID impact. So we're starting to get a feel where volumes are going, at least in the short term. They'll be 50% off. My business is on pause. There's certain logistic issues, getting estoppels, actually checking on work orders, actually be able to market and reach people in this environment, which makes brokerage difficult to process right now. But what's interesting is our investor clients are starting to talk to us about when is the time to come to market, what will the impact, how will you bring stuff to market in this environment over the next 3 to 6 months. So we're starting to look into that. Happy to talk to anyone listening. We have some pretty good ideas about how you can transact in this market. Obviously, the world's going to change a bit in the next 3 to 6 months. So I'm not going to forecast where things are going, but, and I know Visante is going to talk a bit about this, but I think going forward, when you're underwriting transactions or valuation, there's going to be a profound examination of the actual underlying cash flow and the tenancy. And one interesting thing I think will happen is it won't just be industry groups or not necessarily just credit worthiness. People are going to increasingly look at the tenant's function. One of our investor clients, for example, mentioned they have a clothing manufacturer in the industrial building, and that clothing manufacturer's 100% of their business is cruise ship uniforms. So it's not just a question of being focused on a manufacturing sector or clothing sector, but the actual delivery of that product is very tied to an industry that's at risk. So I think you're going to see some very interesting underwriting going forward, both in terms of investment transactions, but also how appraisers will look at the valuation. I'll hand it over to you now, David.
Thanks very much, Scott. Vicente, maybe you could share with the audience, your perspective on changes that will happen in valuation methodology, yields, discounted cash flow, and maybe in your remarks you might touch specifically on industrial and office. So I'll hand it to you.
Thank you, David. So for us, none of us have seen an event like this before. So there's a lot of uncertainty. But looking back at 2008, there are a few things that we think we can expect. There's going to be very limited market activity for the next at least 3 to 6 months. The sales that you see happening in the next month or two are going to be sales that were negotiated pre-COVID. So will not be very good indications of a market. And it could be particularly exacerbated this time around because, a lot of the professionals that you need to enter properties in order to complete transactions might not be able to do so. So doing building condition reports, doing environmental assessments, it's going to be more difficult. Their lawyers and lenders are working from home. And also from the investor perspective, you're trying to tour a property, you might be putting yourself at risk. So it could be particularly acute this time around in terms of market activity being slow. Typically, the first sellers that you see are the poor sellers, people that can't hang on to the property any longer, or power sales, receiverships. But so far, lenders have signaled that they are willing to be flexible. So as a first step, looking at deferring principal payments. And as a second step, potentially looking at deferring interest payments. So that might prevent seeing a flood of power sales coming to the market. So if that's the case, it might be even slower than we expect, right? But what we are looking at in terms of where we see some market weakness will be on the leasing side. And that problem of limited market activity, the solution is to look at the leasing side and what we can expect there. So one of the big themes in Toronto in the last couple of years was rental growth, leasing rates growing much faster than inflation. So, people would underwrite, and give you an example on an industrial property. If you have rents in place at $6.50 a square foot, you would hope that, or you would underwrite with the idea of once the lease in place expires, you ratchet that up to $9. And, cap rates largely became irrelevant. So, a 3.5% cap rate wouldn't really mean much in terms of the actual yield an investor was getting. So, we're going to be very much looking at market leasing activity to see where the market is going. And, when you look at a discounted cash flow, your 10-year analysis, typically about 50% of your value is going to be within the reversionary value. So, that's where really we'll see values take a hit if that happens. So for instance, if we see market rents decline 20% and the reversionary value declines 20%, that could be a 10% decline in today's, when you discount it back to year one. And you couple that with potentially losing some rents in year one, tenant goes dark, it could be a hit of 2 to 5% in value based on year one NOI. And then, if cap rates were to move up 25, 50 basis points, that's how we could see a 20% correction materialize. So for us, we're going to have to be watching market leasing very closely. But it is important to remember where we're at right now, because at least in the office and industrial sectors, we're coming up from, the historically low vacancy rates. We look at the office market in downtown Toronto, where it's sub 2%. Industrial market, we're sub 1%, well below 1%. So, that's a landlord's market. And if rates were to go up to 3% or 5%, that still is a landlord's market. 7%, at least in the office sector, still a landlord's market. At 10%, you start getting to a more balanced market. So we expect that to happen slowly. We're already hearing anecdotally from on the leasing side that tenants that are on the market are starting to ask for discounts, and landlords are holding their asking rents. And that's why it's important to look at the composition of who the landlords are. So if you look at the office market in downtown Toronto, it's mostly institutional landlords. So those landlords, if they have to wait 12 months to do a deal, they'll do that. They're have low levels of leverage. Mostly institutional landlords. So if they have to wait longer to do the right deal with the right tenant, they're in a position to do that. On the industrial side, that was being driven very much in the last few years by a secular trend, which is e-commerce. And, we expect that trend to accelerate. So, from a perspective of experiments are happening, we talk about people working from home, but another experiment that's happening right now is that many of us have been forced to buy on average 10% of what we buy online to all of a sudden go to 100%. So many households all of a sudden are only buying their items online. Example, like my household, we never order our groceries online, and we started doing it a few weeks ago, and it hasn't been a bad experience. So it really depends how comfortable people are ordering items that they didn't order online before when things go back to normal. We don't expect it to be at 100%, but it accelerates going from 10 to 20% a lot faster than before, than what would have happened, then we should see that secular trend continue and accelerate. We're also seeing how this just-in-time inventory system has its weaknesses, sometimes its stress. And what we are also expecting to happen eventually is that companies will start building inventories closer to larger cities, which will also result in more demand for industrial space. And then another theme that's starting to emerge is the supply chain, and how we would like for some of that to be closer to home, so we don't experience these sorts of shortages. And if, for example, if a company is doing 50% of their sales in North America, they would potentially be looking to do at least close to that in terms of production locally. So that could be another trend that emerges for industrial real estate, resulting in higher demand. So overall, if we do see that market go down, we expect it to be, short-term and medium-term, long-term to continue that upward cycle. On the retail side, it's really that's where our discounted cash flow models will be more important. One of the things that we'll probably see happen is we'll see two group of properties. We'll see the properties with national tenants, and I'm thinking of a grocery store anchored plaza with pharmacy and some other smaller retailers. That those properties will see stability. And then you'll have the second group of properties, which will be the older strip centers with not very many national tenants. And as well with street front retail properties, we expect the same, where there will be some vacancy, and that market will be more challenged. But one of the things in Toronto that it was already happening is that people are looking at some of these properties as redevelopment opportunities. So we would probably do not just rely on the discounted cash flow, but it's probably important as well to start looking at the highest and best use analysis a bit more, because for some of those properties, the floor and pricing might become the land value. So that will also be important for some of those properties if we see them not stabilize. And there might be the odd situation where some properties are now development sites where we might have had a long-term tenant that did not facilitate that, and now they become available for development. So that's the high-level overview for Toronto. Back to you, David.
Thanks very much, Vicente. So we'll move west into Alberta. Mark, if COVID wasn't enough, you're fighting a couple of different crises now. Maybe you can share your observations on the market and things that you anticipate that will arise.
Sure. Thanks, David. Alberta's certainly in a unique situation relative to other Canadian cities because, not only are we experiencing pressure from economic downturn caused by the COVID pandemic, but we're also in the midst of suffering through, oil pricing lows that are, date back 20 years. So, the long-term strength of our real estate market is inherently tied to the strength of our economy, and certainly we're getting hit on multiple fronts in Alberta. New supply in the oil and gas market continues to grow and come on stream mainly from the US, Russia, and Saudi Arabia, and demand has fallen sharply because of quarantine measures, and people globally aren't consuming as much because they're staying home and not traveling. So, just to put things into perspective, global production is, in around 100 million barrels a day, and global demand has fallen roughly 30 million barrels a day. So, even with this latest OPEC agreement on Monday that, has got players at the table to cut production by, 10 million barrels a day, it's still not enough. And that's why we didn't really see a major shift in commodity pricing after that announcement Monday. So, in 2020, commodity prices have fallen roughly 70%. WTI, which is the North American benchmark, was trading at 63 a barrel at the start of the year, and that's now plunged to 20 a barrel. And so what does that mean to Calgary producers? Well, most companies are hedged for a short period of time, but are not economical in the long term at a $20 price point. So there's certainly going to be pain on the horizon for Calgary producers. And most of the large companies have already announced major cutbacks in spending on capital projects. Estimates put that to the tune of $7 billion. And that translates almost immediately to, a softening economy here, to job losses, and to kind of lower wages for people who are working in the oil patch. It is important to recognize that not all asset classes in Alberta behave similarly and will be affected similarly by an economic recession. So it becomes important as a valuation expert to, understand the individual nuances of each asset that we're looking at in each asset class. So when we approach valuation assignments in post-COVID times, we're going to have to exercise caution. As pointed out previously, there's going to be a lack of data, and we feel that it's not necessarily appropriate to put a broad discount across all assets. Contemplating cash flow models is the primary tool now used, certainly for investment grade stuff. The type of tenants and the risk profiles become much more important, and understanding the leasing end and how that relates to cash flow is absolutely critical in a falling market. It's no longer the status quo, and historic data is much less valuable. So it's really important for us to have real-time connectedness with our brokerage groups on the leasing side as they're working with landlords and tenants and pegging the market. If there's one thing that doesn't really stop, it slows down, but it doesn't stop during times of crisis like this, is lease deals. So, from an investment perspective, assets with strong leasing and strong covenants tend to be less affected, where assets without those attributes certainly suffer more. So for, discussion purposes, maybe I'll just touch on the Calgary downtown office market. Unlike the rest of Canada, we've experienced quite a decline in value over the past 5 years, and that hasn't been mirrored in industrial, retail, and multifamily in Alberta. So, really what's important to focus on is an asset, when we're looking at an asset class like this, is what's fundamentally causing the change in value, and that's a drop in cash flow. So, in Calgary, 70% of our downtown tenants are either oil and gas tenants or service clients that support oil and gas companies. So we are, inherently connected from a real estate perspective to the health of the oil and gas market. And in 2014, the industry started to shift, cracks were starting to show, and it looks like supply was starting to outstrip global demand. By 2016, 100,000 jobs in Alberta had been shed in the oil and gas sector, and that plugs into real estate in that it reduces demand for space, and it created a negative absorption environment for a number of years in Alberta. Coupled with that was an increase in inventory with new products that had been conceived when markets were much healthier. And the development timeline for office buildings obviously is 3 to 4 years. So, no one predicted what was going to happen in the marketplace. So, we were caught in a storm of declining demand and increasing inventory. Vacancy rates moved from, call it 7.5% across the board to north of 25%. And the impact was felt almost immediately on achievable lease rates and NERs. And, looking forward, the fundamentals of the downtown office market had changed. And, but we didn't really have any transactions to benchmark against. In 2012, which would represent more of a healthy market in Alberta, there were 10 office transactions that were downtown in excess of $25 million. In 2014, 2015, and 2016, there were 2 trades, excluding a 50% interest transfer between two institutional investors. So what we're seeing today, given the COVID pandemic, is what we saw in 2014, 15, 16, where deal volume dried up as people were trying to understand, what was the appropriate price and what was happening to the value of real estate. And in the absence of sales, what we relied upon as appraisers and as professionals in the industry trying to peg value was looking at leasing data and cash flow models. So, obviously, as lease contracts expired and leasing was renewing, we got a glimpse as to what was happening in the marketplace real time. We didn't, and it was quite bleak and probably more impactful than what people thought in the short term. So, but that being said, Calgary's office market had fundamentally shifted, and I don't necessarily think that's going to be the same. I don't think COVID's going to have the same impact on a long-term basis. And I think in the short term, there's going to be no liquidity and a freeze on transactions from a sales side for 6 to 12 months. We're going to continue to see leasing. Discussions with leasing brokers active in our marketplace have been, have indicated that deals are still going on, but people are trying to, push and delay things because it's just not clear what's happening in the industry. So key things to consider is that real estate values don't typically change overnight. Short-term shocks like the COVID pandemic reduce liquidity and hinder financing, which further reduces liquidity. So I think it's fair to say we're going to see and experience a period of inactivity while the industry players kind of wait and see what's going to happen in the marketplace. Cap rate analysis, as Vicente pointed out, isn't really that valuable because income profiles for certain assets are going to be reset. Even in the short term, on a 10-year horizon, if retail rents fall for a couple of years and then go back to normal, it's important to capture that change in a discounted cash flow and becomes less meaningful on a cap rate analysis. So as economic pressures subside within the year, I think some asset classes like industrial won't be as affected, where we may see a reset in retail and industrial, especially if consumer behavior changes in the long term. But at this point in time, it's really too tough to say what that impact is going to be. But what is inevitable is that leasing will tell the story in the short term, and deals will continue to happen as contracts expire and get renegotiated, and eventually the sales will follow, and that'll give us a clear picture of what's happening in the marketplace. So, that wraps up my end, David. So maybe I'll pass it back to you.
Mark, thanks very much. Alberta needs to get a break. Hopefully it'll come soon. James, Vancouver, perhaps in your remarks you can include your thoughts on retail. Development land is always a topical issue in Vancouver, so it would be great if you could talk to that. Your perspective on tenant composition. So why don't we turn it to you and hear your thoughts.
Thank you, David. So retail, I think both Vicente and Mark and Scott have alluded to the fact that retail is probably not going to fare as well as office and industrial or even multifamily. Looking back to the 2008 crisis, retail assets saw between a 75 and a 200 basis point rise in cap rates when they finally started trading. We don't know where they're going to go at this point, but I think, like Vicente said, the redevelopment potential of a lot of these larger sites in Metro Vancouver could be a floor to value. Grocery and drug anchored retail obviously is going to fare better. I saw a statistic yesterday that said from StatsCan that grocery store sales were 16% higher in March than they were in the week before Christmas. So there are some good stories. To that end, I think we're going to initially make use of what I like to call small lever valuation metrics in our discounted cash flow. So we'll look at renewal probability, lag vacancy, rent growth, market rental rates, as these are really tied to discussions we're having with brokers, REMS, internal data, and information from our clients. We're really going to get down into the rent roll and look not just at tenant group, but individual tenant business. So Google will be our friend here, looking up the backgrounds of some of these business. I think, David, you gave a good example yesterday that really stuck with me, like law firms. That's an industry category, but an HR law firm will do better, I think, in this crisis than maybe an import-export law firm or maybe an oil and gas merger law firm. So we're going to dig down into the rent roll, each tenant, and see exactly what are they doing. Like Scott also mentioned with the clothing manufacturer that makes cruise ship uniforms. So I think when we do that, we're going to add tenants to groups with higher failure potential. So restaurants are going to be particularly challenged, some fashion segments. David and Vicente, maybe we don't know much about hair salons, but I kind of think they might be a bit challenged. But there are people who say they're going to see a flood of business once we start going back to normal. So that one might be up in the air. But we would apply an additional credit allowance to those tenants. Another thing we're going to look at is retail sales. So it's not just about percentage rent now, it's about tenant health. And so, we're going to get into the GROC analysis, gross occupancy to sales ratio, and compare it to what we've seen in more typical times. Just to get a sense of, how much certain, subsegments of industry are being impacted. Another stat to jump over to the cap rate and discount side, which we aren't seeing evidence of yet, but we were seeing cracks leading up to this, as Scott mentioned. RealNet has sales volume in 2019 of around $900 million to $1 billion. So that compares to $2.4 billion for 2018 and $3.3 billion for 2017. Now those were run-up years, but I went over and looked at RCA Analytics, and for the province of British Columbia in 2019, we did about $2.5 billion in retail sales volume. The last time we were that low was 2011. So we have had a long run up in values, but retail, I think, has some significant headwinds coming into it. But we do have some good news stories on the grocery store side, on the pharmacy side, and the floor is really set in markets like the Lower Mainland for redevelopment value. Just to touch briefly on hospitality, obviously they're seriously pressed. I was reading a story this morning that was talking about single-digit occupancy rates in Montreal. So they're just in a world of trouble. I think our hotel webinar series will probably jump into that more if you're interested. But I think the silver lining there could be if we start to see having to move essential workers, especially healthcare workers around the province, certain hotels are going to do okay. Probably the same ones that put up, rail employees and truckers and those kinds of workers who have to keep working during this time. In fact, they're working more than ever. So that is a potential silver lining there. I think we're probably getting a little bit short on time, so I'm going to hand it back to you, David.
Thanks very much, James. Well, thank you, gentlemen, for your thoughts today. We've made the decision that we wouldn't open it up for questions because we thought it was perhaps an impractical forum for that. But what I would encourage the audience to do is to reach out to each of our panelists to explore some of their thoughts in more detail. They'd be welcome to any conversations. So again, thank you. As I mentioned at the outset, this is the first of a series at looking at different issues and asset classes. We'll be holding a second program on April 24th, led by Matt Burkowski, dealing specifically with the multifamily asset class. For those of you that are on this session, we'll be sending e-invites to you directly. So thank you for joining us today, and we hope that you have a productive remainder of your day. Thank you.